Thanks, Kylie. It's great to be here, and thank you to Mining Skills Australia for the invitation to speak this morning. I guess my presentation, just before we start, Energy Skills Queensland, we're the industry skills body for energy and telecommunications in Queensland. With the recent demise of the Kinetic Group, which was the equivalent of us in the mining sector, we've now basically taken over their role and acquired a number of their key product services and staff. So we have broadened our industry coverage into the resources sector as well with that coverage. So essentially, I guess our role is to work with industry and help them first of all understand what their future skilling requirements will be, and we call that workforce planning, and then putting in place strategies to build the workforce for those future needs. So we work with industry, with key industry stakeholders, with governments, with education training providers, etc., in order to implement these strategies. So some of the things I'm going to talk about today, I know we've heard from Jeff, and there are some major challenges, particularly in the coal sector, but also in iron ore with the commodity prices going down. But there's also some positives, particularly around the gas industry, the coal seam gas industry in Queensland, and the gas industry in WA, etc. So, you know, there are some challenges, but there are also some positives, I guess, from a workforce perspective out there. So I'm going to look at some of the emerging projects, some of the opportunities where the growth has been and where the growth may be into the future. So we've got a number of statistics that we'll sort of run through, which sort of demonstrates how much the industries have grown over the last sort of 10 years or so, and tempered with obviously some of the issues around some of the recent downturns occurring. So I guess this first slide really shows that you know, as far as the value of advanced projects, now these are projects that are either currently under construction or have achieved their final investment decision. So these are new projects occurring across Australia. We are at a historically high period for capital investment, and currently $268.4 billion worth of projects are at their advanced stage, have either had their final investment decision or are through currently undertaking a construction process. Now, given the majority of these projects, $200 billion worth of these projects are in the oil and gas sector, but it's not all gloom and doom across the resources industry. It is a patchwork industry, and in fact, in the last 6 months, there's been $13.2 billion worth of approvals. Once again, predominantly in the energy and gas sector, across the last 6 months, increasing this curve up until $268 billion. The largest of these was the extra train for the Australia Pacific LNG project out at Gladstone. And in fact, the 10 most expensive projects worldwide, 6 of those projects are here in Australia, and 3 of those projects are in Queensland, and they're all essentially gas projects. So I guess this is a snapshot of the Queensland labour market. In the last few years, there's been some winners and there's been some losers. There's the mining and the utility sector has grown. Even the health and community services sector has grown significantly from a workforce perspective. But as we know, industry sectors like manufacturing, retail, accommodation and food services, really related to tourism, and the construction sector, their employment has gone backwards. And in fact, in Queensland in the last 12 months, 51.5% of all new jobs were generated in the resources sector, predominantly in the gas industry, the construction phase of the gas industry. If we look at this next slide, this really tracks across Australia the number of employees within the energy and resources sector over a 20-odd year period from 1984. And you can see from about 1984 to 2004, it's a fairly constant workforce of around about 100,000. Fairly constant, a bit up and down, but from that period, 1984 to 2004, fairly constant. But from 2004 to 2012, we've gone through a massive growth in employment numbers, significant, unprecedented growth. Now, there has been a downturn of late, as we know, particularly in coal, iron ore, but just the amount of growth that has been experienced over that years has put significant pressures on the labour market, and particularly on skills and sourcing skilled workers. And the impact of this has been significant. We'll talk a little bit about that as we move forward. If we just look at state-by-state basis, as you can see, WA is still well in front with number of employees in the energy and resources sector, but has had a dramatic downturn just in the very recent period. Queensland, according to these figures, now these are ABS statistics, has trended down, but according to these figures, it's trending back up again. But these are August 2012. We would expect that that's going to be trending down quite significantly over from that period, August 2012 to June 2013. New South Wales trending down quite sharply, but then other states are a fairly flat line or slightly trending up. This is some analysis done over the last few years, looking at projected growth of workforce, three particular scenarios: the low range, which was done by the federal government's National Resource Sector Employment Task Force back in 2009, 2010, the mid-range, which was undertaken by Skills Australia, and the high range projection for workforce growth, which was done by the Queensland Resources Council in Queensland. The actuals is quite volatile, but up until the end of 2012 was actually well above those projections. Now, we are expecting that to trend down quite significantly in the next when this data is done next, but it's still quite well above those projected scenarios. And some of the work that was done back then indicated this was the supply forecast, the forecast of skilled workers available within the Queensland labour market. And as you can see, there is still a significant gap, even with a significant trend down. There is still a fair gap between the demand of workers and the current supply of workers within the labour market. Once again, just a closer look at Queensland. From the global financial crisis to now, there has been 35,000 new jobs created in the energy and resources sector in Queensland. And in fact, according to these ABS statistics, over the last 20 months, we've had a growth of 19,000 jobs. Now, albeit these figures tend to have at least a 6 to 12 month lag, we are expecting that to trend down significantly, based on what Jeff was just talking about earlier, with the reduction in workforce in the coal industry, particularly. But then if you look at the Bureau of Resources and Energy Economics, BRE, their projections over the next sort of 4 years, and this was done in April 2013, so this is fairly recent. If you look at the numbers coming out of BRE, they're projecting a growth in Queensland of 30,000 workers, cumulative up until 2017. Now, once again, their next forecast may be significantly reduced based upon more recent data coming out, but it's just interesting to compare what BRE are suggesting with some of the anecdotal stuff that we're hearing and some of the stuff that we've heard earlier from Jeff this morning. And some of the mixed messages that we're getting are quite interesting. You know, the media is very much gloom and doom, very much negative. And a lot of the companies we talk to are quite negative as well. But then other companies that we talk to have a different perspective on what's going on. So there's quite a lot of noise out there, and it's quite quite interesting to compare. But clearly the gas, the energy sector is going quite well. Other sectors are not going quite so well. This is just a snapshot, I guess, of the key jobs that are, the key critical jobs that are experiencing some shortages, predominantly the sort of engineering, geoscience roles, traditional trades, technician roles, health, safety, environmental roles, but probably where the greatest shortages has been for a long period of time and will probably continue to be is in those statutory roles like open cut examiners and explosion risk zone controllers, supervisory roles and site safety and health representatives and those sorts of things. Fly in, fly out, as we know, is a significant challenge to the industry. The cost of fly in, fly out is a significant burden, but it's something that's been increasing significantly over recent years. And we can see a bit of a noisy slide, unfortunately, but we can see for the mining sector, for example, 25% of the workforce at the moment is undertaking a fly in, fly out sort of role, and in WA, nearly 25,000 workers in WA are operating as fly in, fly out workers. And out of Sydney, 16,500. Out of Melbourne, just over 14,000. Brisbane, just over 13,000 workers, and so on. So a significant proportion of our workforce is fly in, fly out, creating all sorts of challenges, social impacts, but predominantly major costs as well. And some of the work that's been done, some of the research that we've undertaken and other organisations have undertaken, is that the attrition rates with fly in, fly out workers is almost double the attrition rates of non-fly in, fly out workers. So there are some major issues around retention of staff undertaking fly in, fly out. There's been a lot of discussion, I guess, around productivity in the media, and I guess this slide really demonstrates that any productivity gains that the mining sector has achieved, and the blue line's labour productivity, we can see productivity growth of a peak in about 2001, 2002. We've basically traded all of those productivity gains off over recent years. We've gone from a 175% productivity growth at the peak back down to where we were back in 1990, 1991. So the productivity of our resources workforce has gone backwards significantly, and I guess there's a whole range of reasons for that. I guess the growth of the industry is part of the reason, bringing in large numbers of new inexperienced workers that potentially don't have the exact skill match to what the industry is looking for. Turnover issues with significant growth tends to increase turnover rates and replacement rates, etc. All of those things have an impact upon productivity, but also the cost of labour obviously is a major factor. As the cost of labour goes up without any improvements in efficiency, obviously the productivity is significantly diminishing. We've identified, I guess, that traditional trades are a major critical role that have been in shortage over many years and probably will continue to be in shortage, particularly over the next few years. And we know that the only way to create tradespeople is to train them through apprenticeships and such. And unfortunately, we have this cyclic approach to training apprentices. In boom years, we tend to train more apprentices than we do in bust years, obviously. I guess this slide basically compares the All Ordinaries with the number of apprentice commencements. And as you can see, the number of apprentice commencements virtually tracks the All Ordinaries virtually exact. So in good times, when the share market is buoyant, when companies are making money, they're employing apprentices. In tough times, when the share price is down, when companies are not making as much money, they're very loath to take on first-year apprentices. But what that means is 4 years down the track, there's going to be a lot less tradespeople emerging into the labour market with the types of skills. And as you can see, we had a peak in 2008 of new apprentices commencing, and those apprentices that commenced in 2008, 2009 would be coming out of their time, would be entering the labour market as fully qualified tradespeople at about now. And we're just in the middle of a downturn, so we've probably got an excess. We're probably moving towards an excess of skills in that area. But then we've got this massive reduction in commencements, which occurred from 2009 to 2013. So when those apprentices would be completing their time 3 to 4 years later in 2017, when there could be another swing back up, we're going to have a lot less tradespeople out there. So if we're expecting a swing back up in 3 years' time, and demand for people with these sorts of skills is likely to increase, there's going to be a lot less of them out there in the labour market. So there's going to be possibly going to be a significant gap of people with trade skills. I might just quickly run through, so I'm not going too much over time, the demographics of the mining sector. This is some work that we've done through our Heartbeat project, which clearly identifies that the demographics are skewed towards a more mature workforce, as you would expect, I guess. As far as recent hires tend to be a bit more mature on average than the current workforce. So we're not actually adding any younger people to the workforce. Now this next slide, I guess, is an interesting one. It just sort of shows the bars, shows the percentage of the workforce that are eligible for retirement. So there's some critical roles here that are a big concern. Open cut examiners, deputies, like we've got over 20% of open cut examiners are at the age where they're eligible to retire. Significant risk there. And the new people coming in, over 50% of those are older than 50 years old. So I know this is a role that requires people with a significant experience that you're only going to get from working a number of years in the mining sector, but there is a big risk here. Deputies as well, and the interesting thing about deputies is the new recruits that they're bringing in are significantly older than, on average, than the existing ones. So there are a number of major risks with those two particular occupations, but even drillers as well is one that's at risk. I guess the next slide looks at some of the consequences. You know, this whole thing about wage inflation is significant, and some of the research that's been done shows that our current pay rates are 30 to 50% above what they are in the US, and even young tradespeople, for example, are earning $200,000 a year. And in fact, there are some isolated cases of some specialist tradespeople, for example, a cryogenic steel welder working on an LNG plant at Gladstone, for example, earning above $400,000. And we've all heard the media coverage around the Gorgon projects, cost blowouts, and some of the LNG projects in other states. So this whole wage blowout really being driven by a shortage of skilled workers is putting significant upward pressure on wages. So the only way to manage that is to increase the supplies, to get more skilled workers into the system. So I know we're running out of time, so I won't spend a lot of time on this, but some of the things that we're involved in, we're currently working with the 4 gas proponents in Queensland to review their workforce, their future workforce over the next 10 to 15 years, undertaking a workforce plan, an industry-based workforce plan to really clearly identify what their future demand for skills will be against the critical occupations, how many they'll need, where they're going to be required, what geographic location, and when they'll be required. And then that helps the industry put together a good plan to actually ensure that those people are being skilled in a timely manner. We know it takes 3 to 7 years in some cases to get people skilled up. So if we need somebody in 7 years' time, we've got to start skilling them now. We're in the process of redoing the Heartbeat report. Some of you would have been involved in this report previously with the Kinetic Group, where we're rolling this out again this year. It's a report that's free to be involved in. It's really an industry pulse survey. Historically, we've surveyed over 50% of the mining workforce in Queensland to get a clear snapshot of their growth, the staff turnover and retention, the non-resident workforce, the demographics of the workforce, what are the critical job roles, and a whole range of factors. And this helps, I guess, us to provide good quality information to the industry. It also helps particular organisations that participate in it to actually compare what's going on with their organisation with what's going on more broadly across the mining sector. So it's a good benchmarking process. So these are just some of the key statistics that came out of the last Heartbeat project. I won't sort of spend too much time on them. This is just an example of some of the data that came out for a particular occupation, looking at the supply availability, the eligibility to retire, so what percentage of the workforce could be leaving, the turnover rate for new hires, and the long-term turnover rate. So it really helps, I guess, organisations to plan for their future, to identify what are those critical occupations that could put the organisation at risk. Some of the other things that we're involved in is upskilling and cross-skilling strategy, so working with companies, predominantly gas companies in Queensland, to train for specific occupations, instrumentation, control system workers, gas work authorisation competencies, developing those, process plant operator training, training drillers and well servicing staff. We've been involved in getting literally hundreds of people into the drilling industry in Queensland for the coal seam gas industry. Other strategies, helping more people get into apprenticeships is a key, and running pre-apprenticeship programs to attract the right sort of young people, to give them some of those essential skills that they would need to successfully complete an apprenticeship, helping them complete basically all of the first year of the apprenticeship up front so they can then accelerate through the program and complete a bit earlier. And these programs tend to also increase the percentage of participants that actually complete. Up to 50% of apprentices do not complete their apprenticeship. And studies that we've done is people who've done these sorts of programs, 85 to 90% of those actually complete their apprenticeship. The other thing that we're doing is our Queensland Workforce Skilling Strategy, which is really targeting some of the skill surplus regions of Queensland, some of these coastal regions like Bundaberg, Rockhampton, Sunshine Coast, Gympie, and training people with the sorts of skills that's going to get them an entry-level job within the energy or resources sector, and then moving them into roles into that area. Also, Indigenous workers, probably about 50% of the people that we put through this program have been Indigenous, and as many of those Indigenous people are actually gaining jobs as the non-Indigenous program. So it's been highly successful. I think last year we put nearly 500 people through that particular program. We're in the Indigenous employment training space. We're also doing a fair amount of work here with Arrow as one example, but also with Queensland Gas Company, and also with Santos as well, helping them develop programs, successful programs to recruit Indigenous workers, give them the right sort of training, work readiness training, some skills, and then moving them into a range of different jobs that suit their background, their skill level, their attitudes, and so on and so forth. And these have been highly successful. 65 to 70% of those participants have been moving into jobs. Working with training organisations to help them build their capability is also something we've been working on as well. So getting industry to partner with training organisations and supply specialist equipment such as gas compressors and those sorts of things, so that training organisations have the capability to train new workers and upskilling existing workers with the types of skills. You know, the coal seam gas industry, for example, is a very new industry to Queensland. There isn't the infrastructure and the capability in many cases to actually train these workers. So building that capability is something that we've done a significant amount of work on. So I guess just in summary, you know, there are some issues with coal and with iron ore, and there's some downturns, but there's also some other areas that are growing significantly. It's a skill shortage, not a labour shortage, we believe. Skill shortages increase costs and reduce project viability. Skill shortages can be improved by strategies to develop a workforce for the future, workforce planning and strategic workforce development strategies. And industry, we believe industry needs to work collaboratively, needs to work together to achieve these outcomes. It becomes a much better outcome where a number of companies are working collaboratively and putting in place long-term strategies to resolve some of these issues. So I am a little bit over time, but I think we'll probably leave it there. Thanks.